That sounds great.
Great. All right. We'll give it a couple minutes here. Terrific. Well, so we've got folks now entering the room, and I see out there that that our participant number is climbing. So I'm thrilled that on behalf of ACG Los Angeles, we've got this level of interest in the CARES Act and COVID-19 and really the federal response. This afternoon, we're joined by Jason Mulvihill. Jason currently serves as Chief Operating Officer and General Counsel for the American Investment Council. As Chief Operating Officer and General Counsel, Mulvihill has responsibility for legislative, regulatory, and international matters. The AIC is a Washington, D.C. based advocacy organization established to develop and provide information about the private investment industry. Before joining the AIC, Jason served as Legislative Director and Chief Counsel for Senator John Ensign from Nevada. Jason joined Senator Ensign's staff after serving as Senior Counsel for the Senate Committee on Commerce, Science, and Transportation, and before working on Capitol Hill, Jason practiced law at Skadden Arps. So Jason, this has been, as we were talking about, relative to inside the Beltway, a fast moving, and for us outside the Beltway, sometimes unclear process. So we'd love for you to take maybe the first 30 or so minutes to give us your insights into the process so far, where you say we are today, and then what you and AIC are looking at or looking for in the near future. So Jason, help us understand kind of where we are in this environment.
Absolutely. Well, thank you, Michael, and thanks to all the ACG Los Angeles team for letting me join you. I hope this will be helpful for all of you. And as Michael said, I'm happy to kind of run through our top level takeaways on the state of play, where things stand, also highlight some of the issues that we're going to be looking to address going forward that may be relevant to you. And then happy to take whatever questions you all might have. So I think sort of starting off with the kind of 50,000 foot view here, obviously, the whole COVID-19 crisis kind of came about unexpectedly. And I think it bred a bit of an unexpected response in Washington as well, not necessarily a negative one. But I think what we saw as things began to shut down is both the administration working with state governments and also with both parties in Congress sort of agreeing, although they had many disagreements, that they needed to act and they needed to legislate to provide some relief, because if you're going to turn off the economy for a while, there's obviously going to be tremendous consequences to that. And so there has been a fair amount of legislation and regulatory relief measures that have moved relatively quickly. And I think, speaking from the AIC's perspective, our primary goal as this legislation has taken shape and as the regulations have followed it is to ensure that to the greatest extent possible, private equity-backed businesses that would otherwise be eligible to receive relief, but for the fact that they're private equity owned, have access to as much relief as possible. And I think for now, certainly there were some good relief that we can talk about that passed as part of the CARES Act, some favorable tax relief, and some favorable relief through Title IV regarding Main Street loan facilities that will expand upon that the Federal Reserve and Treasury rolled out last week, and that there's a comment period that's now underway until Thursday. So there's a lot of good things there. I think there's also, we saw in the Paycheck Protection Program an example where sort of existing law that had been in place for a while to prevent investor-backed businesses from getting relief from the SBA kind of collided with the intent of providing as much relief as possible for small businesses, with the short-term effect that with the exception of some portfolio companies that may be in the restaurant, food service business or the accommodations business, or that may have support from an SBIC, it's very hard as a practical matter for many private equity portfolio companies to get access and relief under the PPP. And we're certainly trying to do more on that. So more on that as we move forward, but to kind of get back to the top level, right? So there's really been so far 3 major pieces of legislation that have passed in the Congress. At first, there was a phase one bill that was about $800 billion. That was for medical related research, outbreak response efforts, et cetera. There was a phase two effort, which dealt with another $200 billion for individual health, for unemployment insurance, and for food related benefits, the SNAP program. Then there was the part of the relief that most people have spent the most amount of time focused on, and that is the $2+ trillion of relief that passed as part of what's called the CARES Act. And that included relief that was targeted not only at individuals and small businesses and mid-sized businesses, but also distressed industries like the airlines and industries that are important for national security. And so my goal today for the next half hour or so is to kind of walk through the highlights from each of these areas. And then I'm sure that you will have questions. I'm sure we'll get a lot of questions on the PPP in particular. You may have questions on the new Main Street loan facilities that the Fed unrolled in sort of proposed form last Thursday. Happy to discuss that. I'm also happy to discuss some of the unsettled business and issues that are sort of forthcoming, because if there's one thing that Washington does, and one thing that members of Congress from both parties do, is they like to be seen as legislating. Whether or not the legislating they're doing is always on target, that's of course always debatable. But you can rest assured that once Congress gets back into session, most likely not before early May, that they will start legislating again to provide additional relief. And I think where we sit vis-a-vis COVID at that point, if we're starting to have really bent the curve on COVID and the sort of the health impacts of it are being reduced, and the number of new cases is also flattening, I think you'll see the efforts that are undertaken in Congress in the next step focus more solidly on economic issues, on getting, helping the country sort of get back to work after a good 2-month hiatus. So again, some of this is all contingent on where things sit when we get to May. But I think that's sort of, rest assured, there will be additional legislation, and therefore also additional challenges and opportunities for the private equity industry to make sure that our firms and portfolio companies have access to the same sorts of relief that every other type of similarly situated business does. So I think maybe we'll start off discussing the Title I part of CARES Act, which was the small business loans, the Paycheck Protection Program, the so-called PPP loans. And I think the important thing to consider when you're looking at these is that this is a program that was built on top of an already existing program that was operating and has been operating inside the Small Business Administration for quite some time. The idea was effectively to plus up and provide a large swath of money, or a comparatively large swath of money, into this program to provide aid to small businesses with below 500 employees and sort of operating throughout the country, right? Because everyone, small business plays an essential part in the economy. I don't think anyone disagrees with that. And certainly politicians are always wanting to show that they are assisting small businesses. So this plan came out, and Marco Rubio, senator from Florida, played a big role in advancing this relief. He's a leader on the Small Business Committee in the Senate. He worked with Ben Cardin, who's his Democratic counterpart in the Senate. And they developed a sizable increase from $49 billion to $349 billion for this relief. Now, the relief has a number of requirements, and I'm happy to kind of run through those. First and foremost, you have this limit on number of employees, and it's 500 employees for small business concerns. There are some exceptions to that, which we can talk about in a little bit, depending on if your small business is a food service business or an accommodations business. There is a proviso that basically says that as long as you have 500 employees at each facility that you have, 500 or less, then you're eligible for relief, assuming you are what's called a NAICS 72 business. So you have the ability to get that additional relief. And they provided some additional relief for franchisees, which they've subsequently tried to improve the clarity on through additional regulation. And they provided clarity that said if you're a business that has financing from small business investment companies, then you also are not subject to the strict 500 employee count. Now, where this 500 employee count gets problematic for all of you and for us back here in Washington is that the rules had always historically said, well, basically, if you are a small business that is owned by an investor or owned by someone else, you have to collect all of the employees that they may have at other businesses that they own and count that in your pool. And some have sort of jokingly referred to this as, this is sort of the revenge of sort of the, sort of the saltwater taffy crew, sort of the two-person small business that wants its relief, and the suspicion on the part of some policymakers of not wanting to give relief to other small businesses that may have a few hundred employees rather than one or two. And so this has been in place for a while. We tried at the AIC, and we also worked collectively with ACG and a number of other interested parties to get a broad relief for affiliation in the CARES Act. Unfortunately, that broad relief from affiliation was turned down for a variety of reasons, most of which were not PE specific or PE related. They were working very quickly to get this bill done. They had tried to work within the confines of the underlying law. And so we were left sort of where we were with some limited relief for some portfolio companies, but lacking in relief for most of our small business portfolio companies. And we'll talk a little bit about, we're going to make an effort as Congress begins to legislate again in May to readdress this issue and provide more relief for other small businesses that are backed by private equity. So that is coming down the road. But if you are able to get access to this relief, the relief is highly attractive for several reasons. The first and foremost being that if you spend the money that you receive in this type of PPP loan on payroll retention and hiring workers and keeping them on the payroll rather than letting them go, that the loan can be forgiven in large part. And so a lot of people have viewed this as, almost a free money proposition if you, keep people hired and engage in the other terms of the PPP. And so it's gotten an awful lot of interest. And I can tell you already, we're all just 2 weeks in to the PPP being open. Already they are running out of money for it. And there already are efforts underway in Congress, which we expect at some point in the near future to pass some additional money. The number that they're talking about right now is an additional $250 billion for this program. That number could go up or down depending on where Congress decides to place the final mark. But we do expect to see subsequent plus up of funding for this program. So right now, the program is sort of running through its money. You can access the program through eligible lenders who've been working with the SBA and with Treasury to do this. The amount of the loans is limited effectively to the lesser of 2.5 times monthly payroll, costs up to $10 million. So there are some limits on it there, but certainly a meaningful number for many, many small businesses. I think we've talked enough about PPP, at least for the time being, because I think it might also be helpful to highlight that in addition to the PPP, and for firms that are saying, I have small portfolio companies that really need relief, but they're unable to get access to it because of the affiliation rules. What are we to do? What else is there out there for us? I think it's important to take a serious look, as we will now, at the additional relief that was provided by Title IV of the CARES Act. This was relief that was broadly referred to as Emergency Stabilization Fund relief, wherein the Treasury Department received a whole series of authorizations to provide money. They provided money to air carriers and cargo air carriers, to money and direct loan availability to businesses that have a national security link for the United States government, and then a very sizable pot of money that was to be used for every business outside of those buckets, and with a focus on helping mid-size and smaller businesses in particular. And for the purposes here, when they say mid-sized business, they're basically saying, a business that has, say, 10,000 employees or under. And so last week, building off of the legislation that was provided, the Federal Reserve, in coordination with the Treasury, rolled out basically 7 credit facilities that they are in the process of standing up. Some of them are facilities that they had announced earlier that they rolled out additional information on, but the ones that are really the most directly relevant for mid-sized and smaller businesses are these Main Street lending facilities. And I think we should spend a little bit of time kind of talking about those and sort of what they do. There are 2 of them currently that have been announced. One deals with existing loans, and one deal is a facility for new loans for Main Street businesses. What do they mean when they say Main Street businesses? Again, 10,000 workers or under 10,000 workers, or revenues with less than $2.5 billion annually. So they were sensitive, I think, in crafting this program to also make sure. There had been an earlier draft that had been circulated around where they were planning to target this for businesses that were between 500 employees and 10,000 employees. They subsequently removed the lower 500 employee threshold, I think on the theory that it was important to provide an additional avenue for businesses that were under 500 employees, but were either unable to get access to PPP support, or even businesses that were eligible and did get PPP support, but needed additional relief, that they have the ability to seek it through here. And so there are these 2 proposals. There's a comment period right now that's going on that will run through this Thursday. The AIC will be commenting on that proposal. I think one of the other sort of favorable threshold relief points that was made clear in what the Fed rolled out last week was that they are exposing this facility to not only non-investment grade businesses, but businesses without a credit rating at all, which is important. And I think obviously so many private equity portfolio companies are either non-investment grade or don't have a credit rating at all, or sort of an investment grading at all. But when you consider that the Federal Reserve is sort of standing up this facility, I think it's important to remember that typically the Federal Reserve, when they're standing up a facility and they're going to be providing access to that facility for private businesses, they historically have limited that to investment grade only, which of course would not have been helpful to the vast majority. Almost every private equity owned business would not have been directly helped by that sort of a limitation. And so it certainly is viewed positively by us that the Fed recognized that in any kind of a Main Street facility, they need to make sure that businesses that don't have credit ratings have access. They also need to make sure, as they have provided, that collateral would not be necessary for these types of loans. That also is very, very helpful. And they have provided, in addition to some of those positive things, they have provided some limits, which I think in the grand scheme of things are to be expected given where the Fed was coming from and what the Fed's mission is, both to help restart the economy, but also to make sure that this money that they're putting on the line, ostensibly with the backing of the taxpayer, is not sort of throwing good money after bad, and that it is actually helping businesses that were impacted, that were healthy businesses before the COVID crisis onset, and that will become healthy businesses after the COVID crisis dissipates. In other words, they don't want to be providing assistance to businesses that were already, tremendously struggling even in good economic times, and now, are in even worse shape because of COVID. So I think there are some limits that are relevant there. I think the biggest ones relate to the EBITDA limitations, where basically in the Main Street new loan facility, there is a debt to EBITDA ratio of 4 to 1. And in the existing loan facilities, there is a debt to EBITDA ratio of 6 to 1. And again, I think if for those who are familiar with the Fed's leverage lending guidance and other guidance that have come out of the banking regulators over the last 10 years, those numbers themselves shouldn't be all that surprising. Now, I understand in the context of many private equity LBO deals, you're going to have portfolio companies with greater leverage than 4-to-1 and 6-to-1. I totally get that. I think the way I would look at this is that, and certainly anecdotally from talking with our members, we expect that probably about a third, and maybe a little bit more than a third of our portfolio companies will be able to access this type of facility should they want to. And I think it's important to sort of mention the kind of the should they want to. Well, why wouldn't you want to access a facility like this? Wouldn't it be helpful? Isn't it necessary at this time? I think everyone needs to make that determination based on the specific fact patterns that their fund and their portfolio companies face. And I think you have to remember that if you are going to take assistance under these facilities, there will be restrictions that will be applied regarding dividends and payments for executives at these portfolio companies, and sort of other metrics that are important that may be restrictive. And basically, you're required to not do sort of dividends and disbursements until 1 year after your use of the facility has ended. The loan terms for this are roughly 4 years in length. That may also prove a bit of a challenge for people because your portcos obviously have underlying loan agreements, and there will be some complexity in figuring out how those loan agreements can work with loan assistance from the federal government, and whether or not that can be stacked in such a way where you're not violating your current covenants and your current loan agreements, or you're able to at least restructure those loan agreements with your employer, with your lenders, without facing additional challenges because of these Fed facilities. So again, there's a lot more to be said on that. And also there's a lot more to be rolled out by the Federal Reserve on these facilities and others in the coming weeks. So as I mentioned, there's a comment period that runs through Thursday on these facilities. That will end on Thursday. Our expectation is that after the Fed internalizes the additional comments that they've received, that they will likely issue additional guidance and sort of final updated versions of term sheets for these various facilities within the following week or two. Afterwards, they're under a tremendous pressure to roll these things out quickly, but they also are working to make sure they roll them out correctly. And that's certainly, I think, a helpful thing for all of us at the end of the day. So that's sort of where that stands. I think the other thing I'd like to say, maybe before I open it up for questions, and certainly there's a lot of other topics we could highlight, but I would mention just two other buckets that I think are worth mentioning. And the first is that the CARES Act did include a lot of relevant tax relief that may be important for your portfolio companies and also for your firms. There is an employee retention credit, tax credit, that basically provides a refundable credit against payroll taxes for up to 50% of qualified wages with a cap of $10,000 per employee. There's also the ability to defer certain payroll taxes. An employer can defer their share of Social Security taxes from March 27th through the remainder of 2020, with 50% of that being due at the end of 2021, and the remainder of that being due at the end of 2022. That is December 31st, 2022. One important thing to note on this, though, is that there is some interactivity with this particular proposal and with the Paycheck Protection Program, which is that anyone who is a recipient of the Paycheck Protection Program and has their indebtedness forgiven under the Paycheck Protection Program is not going to be eligible for this deferral of certain payroll taxes. So there is some interactivity there that portfolio companies and firms will want to consider. Finally, two really important pieces that should be helpful for a large swath of your portcos and your investments: net operating loss carrybacks. As people may recall, in the 2017 Tax Act, there were some changes made to the way NOLs function that basically prohibited businesses on a going forward basis to utilize the full amount of NOLs and just to use 80% of them. Now businesses for 2018, 2019, and 2020 can carry back their NOLs for up to 5 years for losses that were incurred in those tax years, that is 18, 19, and 20. And also for tax years prior to 2021, the taxpayer is permitted to deduct 100% of the loss carry forwards and carrybacks. Again, that is a turning off of the new rule that is put in place by the 2017 Tax Cuts and Jobs Act. And that'll be, I think, a helpful thing for many businesses. Finally, in the tax front, interest deductibility relief. This is an issue that was certainly important for all of us during tax reform. I think it ended at a place where we had a 30% of EBITDA limit put in place through 2021, and then a sort of a scarier and more daunting 30% of EBIT limit put in place after 2021. For the short period of time upcoming for tax years 2019 and 2020, what the policymakers agreed to do here was to change that EBITDA limit from 30% up to 50%. So you can deduct up to 50% of your adjusted taxable income for 2019 and 2020 rather than 30%. And you can also choose to use your 2019 adjustable taxable income for 2020 with the recognition that your 2020 numbers are likely going to be highly off and much smaller. I think that the other thing to keep in mind with this issue is that certainly, and we're very focused on this at the AIC, there is and there remains a ticking time bomb on the 30% of EBITDA limit that does remain the base law underneath this temporary relief. And so there'll be more to come on that. And then I think the final piece that I'll just touch on very briefly, and then I will open it up for questions, is unemployment benefits. And I think the reason to mention the unemployment benefits that were provided in the CARES Act is that they create, in some cases, for many businesses, a perverse incentive. And that's because the way that they were structured, they provide an additional $600 per week and payment for each recipient under the unemployment benefits regime for up to 4 months, and also provides an additional 13 weeks for federally funded unemployment benefits for individuals that are exhausted their state unemployment benefits. And all this is available through December 31st, 2020. I would just say anecdotally, what we're hearing from some of our firms is that they have portfolio companies now where the unemployment benefits that have been basically stacked on top of each other to provide for a bunch of additional assistance in the early goings here have led to a situation at some portfolio companies where it actually, the workers have no incentive to come to work because the way that the program is layered right now, it actually is better for them to stay on unemployment because they're actually making more money because of the way the unemployment system has been plussed up in the short term. So we know that there are some portfolio companies who may be wrestling with challenges there. And again, I expect this may be another issue that will be readdressed in subsequent legislation. There was an effort by Senator Lindsey Graham from South Carolina to try to update the CARES Act before it passed to change this so that the unemployment benefit would not be quite as rich as it is now. But those efforts were stalled temporarily. So and frankly, they may try to change it. Although I think the optics of changing unemployment insurance and carving it back at this point is pretty politically hard and challenging to do. So I think in the near term, you're likely to see these unemployment benefits continue in the current shape that they're in. And again, as I say, the plus side of that is that for those who are unemployed, they do have a safety net for longer and deeper than they otherwise typically would have. The negative for it from a company perspective may be that it may incentivize more people to claim on insurance for a while and get a richer benefit than they might get if they were working in their ordinary job. And that's not something that's unique to private equity portfolio companies. The same is true for any other company of similar size and scope. So with that, I think we're about at the half-hour mark. Michael, I hope that's a good sort of overview. I guess I would say, just in closing before we open it up for questions, and I've touched on this in some of the discussion, but we view the time ahead here as being very busy, not only from the regulatory front over the next few weeks, but also once Congress comes back. From the AIC's perspective, on a going forward basis, both through regulatory relief and legislative relief, our goals remain to ensure that private equity portcos get access to as much relief efforts, as much relief provisions as they would otherwise be able to get if they were not private equity portfolio companies. So we'll be looking for some additional relief on the affiliation rule for the PPP. We'll be looking to ensure that the other Fed facilities that have been stood up, where relevant, allow for non-investment grade businesses to get access to those facilities and get access in a way that works and functions in a realistic way for your businesses, and also to make sure that to the extent there's additional tax relief or other relief that moves forward, that it moves forward in a way that's thoughtful and non-discriminatory against private equity in general. So with that, I hope that's helpful, and I look forward to getting your questions and having a back and forth.
Jason, that's great. Thank you so much for giving us that good 30-minute kind of coverage, high level, a lot of content in there, obviously. And I think any one of those buckets that you talked about is, fodder for a 2-hour webinar on its own. But as you were talking, we've had questions coming in a number of different ways, and I'm trying to aggregate those. So I'm going to run through a couple, and some of these may be deeper dives than you're comfortable getting into on the specifics or not. If so, let me know. But the first one, kind of at a high level, from one of our great longtime members, Jerry Harmon, when you talk about this additional tranche to the PPP, this $250 billion, whether that's more or less, and obviously understand that we don't know what that's going to look like. But do you and the AIC look at that as an if or a when? I mean, are we confident that another tranche is coming? We just don't know when it is and exactly what that dollar value is, or is there a greater variable here, which is it may not happen?
I really, on that specific point, I really view it more as a when and not an if. And the reason I view it as a when is that policymakers on all sides of the aisle and in the administration are strongly for providing more money in the small business relief program through the PPP. So we're already hearing members on both sides of the aisle say, yes, they want to do this. Yes, they want to do this soon. Oftentimes the debate has been about, well, what else should we do as we also plus up that program, right? So there have been some Democratic lawmakers who have said, well, we want to expand relief to state governments, and we want to expand relief in the unemployment space and make some other additional pots of money available to municipalities as well. So I think typically the discussion has been not whether or not we should do it, but when we should do it and what we should do it with. And my sense is that this will all come into crystal clear focus, or maybe not crystal clear focus, but as clear as Washington focus can ever be when Congress comes back into session in May. And they start hashing out the details. But I think for us, as they do look to do that, and as they do look to hopefully do more than just plus up the amount of money that's available there, it's our hope that they will also provide some additional reliefs and tweaks to the program that will make the program work better and expose even more small businesses to that program. So it's our hope that as they consider what else they're going to do in addition to increasing the amount of money that they want to spend on the PPP, that they also look at ways to make it function more practically and on a less discriminatory basis.
Yeah, and some of that, I mean, this goes to another question, and again, this is maybe better asked to a lender or an organization there, but it seems like lenders have different processes for processing the PPP loans. And then keeping an applicant updated as to the status of that. Do you guys have any work that you're kind of pushing forward there in terms of standardization or communication or anything like that? Or is that really left to the lenders individually?
It's really, frankly, it's left to the lenders at this point and working with the SBA. But the one thing I would note for folks who are in the position of a borrower or who are advising and assisting portfolio companies who will be in the position of being a borrower for these loans is that the lenders in the legislation, in order to incentivize the lenders to go and be a part of the program basically were removed from having to, vet a lot of the representations that are made on the applications. So, when you get the short form application, I'm sure many of you have seen it already. It's 2 or 3 pages long, and there's a whole series of representations that borrowers have to make. And basically the banks are allowed to sort of kind of take it on face value for many of those representations, that those representations are accurate. So where this comes into play specifically for borrowers, however, is that borrowers are required and are subject to criminal penalties if they misrepresent, anything on those forms. So whereas a bank is sort of able to kind of, well, that you filled out the form, we're not really going to, check and make sure everything is, all the way set to go, or as long as, the basics are set to go, we're not going to, for example, dive into, all your representations on affiliation, for example, right? A bank may not have to dive so deeply on that because they're not required to do so under the law, but the borrowers will have to. And so the borrowers should be very careful and very accurate in all of the representations they make. Not only because there's criminal penalties that ride with that, and of course, because it's what's in the law. Also, I think there's sort of a secondary point to make, which is that there was on the TARP program in 2009, there will be a inspector general, a special inspector general, a SIG TARP-like figure who will be reviewing and assessing whether this program was run properly, whether there were entities that gained access to this program that should not have based on the statute and the laws and regulations that followed it. And so I think there will be, a fair amount of oversight provided. And there's also an additional congressional committee that will be at least partially chaired by your Californian Adam Schiff that will also be looking into this program. And you can bet that that those people who are sort of looking for oversight will be looking to see if there are examples where businesses that should not have gotten access to this get access to it, and what the consequences will be. So all of that is as just really a way to reaffirm what I'm sure you're already thinking, which is that you just have to be very, very careful as you look at that process and as you try to assess whether or not any of your portfolio companies can get access to it over the near term before there's additional relief.
Yep. No, that makes sense. And so let's stay with the lenders just for a second, but jump over to the Main Street loans. Question here was, will that 5% portion that the bank's at risk for be a problem getting banks to do this? And then same idea, the shorter term of the loan. What do you hear, or what has your input been in those discussions?
Yes. I think on the first question about what will that 5% be an impediment, I think it's possible it will be an impediment. I think we'll really have to see. And I think we will, that question, and I think the answer to it will be made clearer as the Fed rolls out additional guidance on how this program will operate beyond just the term sheet that they provided last Thursday. So I think policymakers are aware that that is a potential issue that they will have to consider, and that they will have to work with banks to ensure, and other lending institutions to ensure that that this makes sense and that they can live with this. I understand they've already had a series of conversations with a variety of banks who are going to be involved in this process as well. So I think that there's sort of ongoing conversations on that point. And your second point, Michael, was could you just repeat?
So the idea that there's a shorter term for the loan, a shorter term to the loan, and in the same way, is that going to provide some sort of disincentive for existing lenders?
Yeah. Yes. I mean, I think the challenge there will be, and it'll also be a borrower challenge too, is okay. So it's a 4-year, at least on the terms as outlined in the term sheet. It's basically a 4-year facility where you have 1 year where you don't pay interest and principal, and then it's 4 years in length. Anecdotally, I can tell you from some of the portfolio companies we've talked with and some of our member firms is that, obviously there are a wide swath of businesses that already have existing loans that are either, of longer duration than that, or are concerned that if they were to take assistance in that scenario, it would violate covenants that they have on their existing loan agreements. And so I think that's an area where my hope would be that our advice to the Fed will be that they need to be flexible with exactly the length and duration of those facilities, and make sure that they also address with the greatest amount of flexibility possible the position that many lenders are going to find themselves in, and also many borrowers are going to find themselves in, which is, they'd like to take an opportunity to that this assistance would be helpful for them, but if they have all these follow-on effects with their other lending facilities, they may be unable to use it, and that may not be sort of the policy outcome that the Fed and Treasury and policymakers want. In other words, they may want to have it be a little bit more of a relaxed process, and a process that can work given the existing loans that are already out there and the terms of those loans. So we'll see what the final contours of that look like. But suffice to say, we're highly sensitive to the fact that the 4-year time period on the loans under the Main Street facilities can be a real concern.
Yeah, yeah. Sticking with Main Street, for that EBITDA limitation that you noted, question here is, when is that measured?
I think it's it's a good question, and I don't have a quick answer for that one. I think it's measured at the time you apply for the loan, but I think it's like after April 9th or something like that. They have like a weird time frame on it. They have a specific time frame on it though, and a lot of people are in addition to the point of looking at the timing on that and whether the timing on that can be used as a way of enabling people to kind of fit within the right parameters for those EBITDA restrictions, is also, okay, are there, how will EBITDA be defined for the purposes of the facility? Is it going to be defined as it is in the loan terms, which would seem to us to make a lot of sense, or will it be defined in a more narrow way per gap or per, something that the Fed would come up with? We're going to strongly urge that the Fed rely on EBITDA as defined in existing loan terms, because we think that that's going to be the most helpful and the most reliable, not only for borrowers, but also for the banks, because these are all terms that they're familiar with, they've negotiated. We think that may provide a little bit of additional flexibility to that term as well, and enable firms to get some additional assistance perhaps. So our hope is that's the way they look at it.
Yeah, it makes sense. Are applicants eligible to take both the PPP and the Main Street facility?
So they are now. There was some clarification that was put out in the release last Thursday that indicates that yes, in fact, businesses that were eligible for the PPP that have taken it are also eligible for the Main Street facilities. And look, I think that's a good result. I mean, at the end of the day, that's a good result. It's also a very good result that if you were not eligible for the PPP or you did not take PPP money, you're also eligible for Main Street relief, and there's no affiliation rule for the Main Street facilities. So you're not going to be caught up by the fact that you may be owned by a fund that has 10 other portfolio companies that number over 500 employees collectively.
Yeah. And then in that same vein, a question that says, we received an economic injury disaster loan directly through the SBA. Would that prevent us from receiving a PPP loan?
I don't think it does. I think the way it operates, and again, you'll have to forgive me because we looked at this a week ago and it's been a week since I touched on it.
Yeah.
I think the way it operates is you get that loan, and then the amount of money that you get in the PPP, let's say you get a PPP loan, it's sort of added into the process, so that if you were going to get like X amount through the PPP, that X amount is reduced by whatever amount you got in the emergency facility that was already given by the SBA. I think that's the way it works. Don't call me on it, but I think that's the way it works.
No, appreciate it. Question here: what are the advantages or disadvantages, if any, right, of the way we're looking at this, of the Main Street new loan facility versus the Main Street expanded loan facility?
Well, I think you're going to have a challenge you'll have potential challenges with both of them. I think the one of the challenges with the new loan facility is you're dealing with 4-to-1 EBITDA limit as opposed to a 6-to-1 EBITDA limit. So to the extent that's relevant, that's one concern. the other question that's come up, and again, people are still sort of sorting through this, is, how can you, in accessing the new loan facility, can you sort of, pay down other debt and then get access to it? Or if you're doing that, does that automatically roll you into the second tranche, the sort of expanded loan facility? And if you're doing this expanded loan facility, yeah, it's a little bit of greater leverage, but how easy is it to expand your facility? How easy is it to sort of expand your loan to begin with? And is it something that people want to do, or do they want to sort of treat that as a way of basically sort of paying off an old debt and then picking up a new one that may be a little bit bigger, that operates in the same way as an expanded loan facility would, but technically works a little bit differently. So I think there are some practical burdens there. And again, I think the other set of practical burdens to consider, to the extent that people care about this, is, you're going to have restrictions on salary for at least at the portfolio company level. You'll have restrictions on dividends that you can issue. And so, there will be some and maybe it's probably less relevant for you guys, but also limits on stock buybacks, which are not really directly relevant for most PE, I would think. Right. But there will be some burdens that are imposed there. And so that I would say would be sort of the, some of the things you'd have to really walk through, and you'd have to assess, given the terms that are available. And again, I think we'll have a better idea once they finalize these different facilities, what all of those burdens will be. But I think I've highlighted most of them that you would be most concerned with, at least as the initial sense. You'll have to kind of, marshal that up against, okay, what your current lending facilities look like, what the economic health of each portfolio company is, how quickly it's going to be that, you estimate, revenue coming back in the door when everyone turns on the switch and, starts the economy again. So you'll have to kind of make a sort of a broad assessment of whether that works in the individual instance. And I will say, I will add sort of one additional commentary that we talk about more from the perspective of the PE industry and less from the perspective of an individual private equity fund in the industry. But I think for those who were in the industry and were in the business during the last economic crisis and during the 08-09 period, where there were a bunch of relief bills, TARP, and all sorts of relief getting pushed out the door by Congress, many may recall that at that time, there were a series of Fed facilities that were stood up that, at least in the initial instance, were exclusively for investment grade businesses, and so private equity portcos didn't really get access to that. And then they were adjusted down the road, and more non-investment grade businesses got access, et cetera. But by and large, private equity didn't wasn't perceived as getting sort of any special treatment, and B, I think as a matter of fact, didn't really get any special treatment. In large part, they didn't get a lot of sort of federal-backed relief in that process. There were some good tax provisions. There was some cancellation of indebtedness income relief that I worked on when I was in the Senate and helped to pass back then. So there were some good things for private equity, but I think there were sort of less things that were driven as being sort of something that private equity was kind of running to the government, taking advantage of. And so I would try to remind folks that, we in the industry face an awful lot of public affairs, public relations issues and challenges. We always do. And that's not going to change, over the course of the COVID crisis or afterwards. But I think what everyone can expect to see is people who have already been skeptical of the industry, who already have attacked the industry for, all the sorts of canards that we could all repeat ad nauseum, expect them to be back, right? And expect them to be back saying, oh my God, private equity, this is incredible. These are the guys that pay capital gains tax, for their investments, you bastards. And then all of a sudden you come to the government with your hand out saying, oh, please, can you please help my portfolio company? We've seen, a real increase driven in part by some groups, including the AFL-CIO and many groups that have been founded, sort of dark money groups, 501c4 groups that have been founded to be skeptical of the private equity industry have gone out and sort of already started to sort of say, private equity shouldn't get any relief from any of these bills. They should be able to get access to different loan facilities. And just you wait, private equity, if you go and get access to these things, just you wait, because the next time we come around looking to sort of re-regulate or, regulate our way out of another problem, we'll be looking to see whether or not you got assistance from the government, right? And we'll be looking to judge you against that metric going forward. So I don't say that to be I don't mean that to sort of ruin give you a buzzkill if you were really looking forward to using the Main Street facility or the PPP if you have a portfolio company that's already eligible for it. I just say it as a cautionary tale, that just be mindful that as you and your portfolio companies take advantage of the programs that you're eligible to take advantage of, just make sure that you are mindful of the larger environment in which you're doing that, and gut check yourself a little bit, because sort of the fastest way to lead to restrictions on the license to operate or more challenging tax rules, regulatory rules, et cetera, be foisted on the industry is if the industry offers up unintentionally a whole series of glowing examples of, oh my God, I can't believe this happened or that happened. And I think, we've all hopefully been around long enough to have seen how that's played out in the past. And we're working very, very hard from the AIC's perspective to tell all the positive stories, all the good things that private equity is doing in a COVID crisis. And there are a lot of great stories from portfolio companies that have, switched their production line to produce hand sanitizer, to rush the production of masks, to provide additional, medical care to those who need it. All those are good things. We need to tell the good story about the things that we're doing. And in particular, even more so when, we and our portfolio companies are availing themselves of additional relief that's being provided, on the taxpayer dime.
Yeah, it's a great point. I know on behalf of Association for Corporate Growth Global and all of the chapters, we've worked with AIC, we've sent letters as well. So it's, that's telling those stories is an incredibly important part of this effort on behalf of our membership organization. But maybe to stay kind of in that lane a little bit for a couple questions. Sure. Question here about, when Congress returns to legislate, and I would interpret that as maybe kind of once we're out of the COVID-19 forest. Do you think there'll be maybe a broader distinction between big private equity and small private equity? And I think we get that question because ACG really focused on the middle market, right? And many of the issues are the same, but as we're talking about some of these programs and then some of the narrative, right? Many of the issues aren't the same. And so wonder here with this question, whether there might be sort of a narrative split or something like that.
I tend to think not, and I think that a split would not necessarily be in the best interest of the industry overall. And the reason I say that is there are a lot of smaller private equity firms that have funds with small portcos. Guess what? The mid-size and big guys, they have that too. They have growth funds. They've got the same sort of challenges. And I think from our perspective, what we want to do is to say, look, if the policy is a good policy, if the policy is one where we want to allow those who invest in businesses over the long term to do so with some additional relief, and the chances are many of the larger firms that have larger portcos, they may or may not be able to avail themselves of different programs, and they may, even if they can, they may not take advantage of those. Mm-hmm. But really, when it comes down to it, no small business that's owned by a private equity fund, whether the fund is a $100 million fund, a $50 million fund, or a $5 billion fund, should be denied access to that program just because the fund advisor, manages more or less money. We think it's much more, the proper policy differentiator there is, are you trying to help a small business? Okay, if the small business, yes. Does the small business have to have under a certain amount of revenue for that small business? Great. Does the small business need to have a certain number of employees or under to get access to certain relief? Okay, that's fine too. But do it on a way that doesn't differentiate either because of private equity owned or not private equity owned, or on the basis of, private equity sort of one size versus private equity another size. Yeah. In the past, I'll say anecdotally, in the past, whenever we as an industry have tried to sort of, tell a story that says one part of us is sort of smaller and better and sort of, and we should get better treatment, it almost never works.
Yeah.
And instead, what has worked better, I think, over time is, people sort of rowing in the same direction, supporting things that are good for the industry writ large. Obviously, there will be things, and I know this from my own membership, as I'm sure you guys do with yours, is look, I have small firms, and our small members are, a few $100 million of AUM, and we have, firms as large as Blackstone, right? And it is true that firms will have a variety of different priorities. Some of that may be driven by size, but frankly, a lot of times it's driven by the needs of their portfolio companies and the particular funds. But, at the end of the day, I think the thing that's been helpful is that by and large, we found an awful lot of agreement on the types of issues that we should be pushing for. And we found that, for firms that are very small to firms that are very large. And so I think we're strongest when we're together, when we're fractionalized, and when we're sort of, trying to run down different paths is when we end up running into the greatest amount of resistance. Because in Washington, here's the other thing I'll say is we all appreciate, the differences in the industry of, what different types of funds are focused on, and whether funds are, broad funds, small funds, industry focused funds or not. In Washington, you're all kind of investors. You're all kind of, like everyone's sort of like like venture capital, private equity, hedge funds, real estate, insurance companies, banks. Obviously, these are all very different things that I've just outlined. In Washington, they're all kind of the same thing. And you have to be able to kind of explain sort of who you are and who you're not, but I think do so in a way that doesn't make it too complicated, because the reality of it is when you go in to see a policymaker, you're either a private equity fund or you're not. And sort of trying to say, well, I'm a private equity fund, but I'm smaller, or I'm larger, or I'm this, or I'm that. It doesn't seem to work all that well. It hasn't worked well in the past.
Yeah, no, I think that's a great answer. We've got a couple minutes left. Let me kind of pepper you with some questions here.
Sure.
This one on the Title IV, include funds usage restrictions other than dividend disbursements, i.e. operational usage restrictions akin to the PPEs. Was it intended to be a more discretionary use funding source for the 500 or less segment?
Yes, it was intended to be. It is by definition less restrictive in use than the PPP.
Right.
Now, that doesn't mean, and again, the Fed is structuring this under what they call its 13.3 authority. So there is a lot of flexibility for the Fed to design this program in ways that allows for greater flexibility, allows to help and provide additional assistance to small and mid-sized businesses and others that need assistance here without some of the challenges that are in the PPP. And again, the challenges that are in the PPP are largely there because of historical reasons. I mean, the affiliation rule is not something that was new, that was legislated a couple of weeks ago. It's been in the Small Business Code for quite some time.
Mm-hmm. How are you guys working with the SBIA?
We're working closely with the SBIA. The SBIA, in addition to representing many small private equity firms, they also represent BDCs and SBICs. And so we've been working closely with Brett Palmer and his team and their members. We have a number of members that are members of ours, are also members of SBIA, just like they're also members of ACG. And so we're working closely with them. And again, going into this next round of legislating, we expect that we'll have advocacy that will be unified in purpose between our two groups.
Yeah. Let's say maybe final one. Do you have an opinion or expectations for COVID-related tax changes and any impacts on valuations?
Yeah. So let me take valuations. So on tax changes, let me say quickly. Obviously, there were a certain number of tax changes that were favorable, tax relief changes that were put in as part of CARES Act that just passed. It is possible that they will look at another tranche of tax relief down the road. What do I mean by down the road? I mean, depending on how long it takes for the next round of stimulus or relief legislation to get off the ground, it's possible there could be a tax code included. It's possible there could be some additional tax relief provisions. But in the event that that doesn't happen right away, I think there is still going to be a residual interest on policymakers from both parties in both houses and in the administration to, after they do the next version of COVID relief, to do something more broader on restarting the economy, right? And helping the economy get back moving again. And so I think in the context of that type of legislation, which may not ripen in May or June, it might take until July, for example, before everyone goes their separate ways for campaigning and the nominating meetings. I think it's possible you could see some additional tax relief. Obviously, we're going to be focused on that, making sure that to the extent there are opportunities to advance favorable tax relief measures, we'll consider those, and also make sure that there's nothing bad that happens in the tax space during that time. You had a question on valuations as well. And one of the things we didn't really get big time to talk about today was BDCs and sort of what BDCs we're looking at. And I apologize if BDCs are not a big focus for folks on the call, but I would expect that at least some of you probably have BDCs that you care about and that would be relevant. We tried during the legislative process to get BDC relief that would, in some cases, either turn off or significantly modify mark to market to enable BDCs to, to provide more relief to businesses that needed it. We also provided a letter, as did the SBIA, to the SEC to provide some relief there. We are pleased that the SEC provided some relief there, but obviously the SEC did not go as far as we had hoped in terms of providing additional relief on sort of mark to market. I think the reality of it is, at the end of the day, is that if people are looking for, I don't think there's going to be holistic changes to market, and there certainly won't be absent legislation, i.e. the SEC is not going to turn off mark to market all by itself. It's going to need legislative action to do that. And I think it still is a long shot that we would see legislation move that would go that far. Now, short of that, I think there are things, and we have been engaged with the SEC. We're going to continue to engage with the SEC, and we're going to continue to engage also with other policymakers on ways where we can try to make the valuation issue, try to solve it as best we can to prevent a situation where people really are, you had a totally healthy company 5 months ago, and now if you just look at the books, it looks like it's dropped in value precipitously, even though the reality is once you turn the switches back on, it's likely going to be worth a lot more than if you mark to market a couple of, a week ago. So that's going to be an ongoing effort, and it's going to involve a legislative and a regulatory slice, I think.
And all this under within the context of a developing presidential campaign on both sides. So it's going to be an interesting
Right.
end to calendar 2019, 2020 to say the least.
That's right. That's right.
Go ahead.
No, I just was going to say, typically in an election year, by the time you get to June, unless you're naming a post office or doing like a Flag Day resolution, there's no substantive legislating that happens. This year, because of COVID, the normal schedule has been turned on its head.
That's right. Well, Jason, we've got, questions that continue to roll in. We could talk about this until well after sundown on the West Coast. I know you're probably already there on the East Coast. So thanks again for joining us for this hour plus. Really helpful to give us both the high level and some of the more detailed insights during the Q&A session. It would be great if we could perhaps revisit and maybe tap you for another hour in a month or so and kind of see where we are at that point as things move forward. So thank you. And on behalf of ACG Los Angeles, thanks to AIC for the work you guys are doing on behalf of the private investment community. We really do appreciate not just the legislative push, but telling those stories, because I do think that's important to be reaching out in that way and telling the story of private equity at all levels.
Absolutely.
For those of you who are on with us, thanks for your time as well. We hope on behalf of ACG Los Angeles, this was beneficial and a good use of your hour. We will be providing this content on the ACG website. So if you want to revisit some of the content or let your colleagues know that the content will be there shortly, we invite you to go to the ACG LA website and see that. So with that, Jason, thanks again. Have a great evening. And on behalf of ACG LA, thanks so much for the work you're doing in Washington, D.C.
Thank you, Michael. It was great to be with you all. Thank you.
Thank you.